Have you ever actually stared at your locum tenant's paycheck and just wondered how on earth the taxes and stipends are really calculated? Well, today we're going to figure out the hidden financial mechanics behind physician contracts together. Seriously, we're going to completely transform how you look at every single offer that crosses your desk from this day forward. Okay, let's just dive right into this massive number, right off the bat. $52,000. Now, this isn't just some random pulled out of thin air figure. No, this represents the potential take-home pay difference on a single 13-week locum assignment. And get this, that difference is based purely on agency margins. Think about it. We're talking the exact same facility, the exact same bill rate, and the exact same locum provider, but a completely different paycheck, depending entirely on which agency actually placed you. You see, large national agencies, the big household names you see absolutely everywhere, they typically operate at 30 to 45% gross margins. On the flip side, boutique agencies, they run much leaner, usually around 15 to 22% margins. So if the hospital is paying, say, a $500 an hour bill rate, a massive chunk of your potential earnings is being decided right there, before you even see the initial offer. Crazy, right? So here is our roadmap for the explainer today. We're covering 1. Uncovering agency profit margins, 2. Breaking down pay packages, 3. Spotting contract red flags, 4. S-corps and tax optimization, 5. Maximizing retirement contributions, and finally, number 6, negotiation levers and scripts. All right, jumping right into section 1, uncovering agency profit margins. Seeing exactly where the hospital's money actually ends up reveals a pretty crucial golden rule. When you break the whole thing down into wages, stipends, agency overhead, and profit, a genuinely strong package should be passing roughly 70 to 80% of the total bill rate directly to you, the locum physician. If your package represents less than 60% of the bill rate, well, that means the agency is retaining a massive margin. And honestly, it's time to start asking some hard questions. Now, the crucial point here, and this is actually something that completely surprised me when I first dug into it, is that sometimes your recruiter truly, literally cannot negotiate higher. Why? Because a master service agreement, or MSA, has tied their hands. Large health systems often use these MSAs with preferred agencies to legally lock in fixed margin requirements. When that happens, your recruiter just has zero authority to offer you more money. Understanding this dynamic is a game changer because it saves you from pushing against a ceiling that structurally cannot move. Let's move on to section 2, breaking down pay packages. When we look closely at how a pay package is built, the numbers are wild. A $2,000 per week tax-free stipend is actually the equivalent of a $3,300 fully taxable wage, depending on your tax bracket, of course. But listen, to legally get this massive structural advantage, you absolutely must pass the 3-factor IRS tax home test. That means you need regular business in your home area, you have to maintain duplicate living expenses, and you cannot abandon your historical home. Without maintaining that valid tax home, those stipends become fully taxable. And trust me, that dramatically changes the entire financial value of your contract. Okay, moving right along to section 3, spotting contract red flags. A massive red flag that's often hiding in plain sight is the 1-year extension trap. Basically, if you extend a locum assignment beyond 365 days in a single area, the IRS actually retroactively classifies you as an itinerant worker, and you do not want that. That makes all of your previous tax-free stipends instantly taxable, which is just an absolute nightmare scenario. Another thing, watch out for contracts with no guaranteed hours clause. That means a hospital can just cancel your shifts during low census, essentially giving you a massive pay cut, and you're left with zero recourse. So, what happens if you've already signed a contract and then suddenly realize you're falling right into an itinerant worker tax trap? Or maybe you're facing uncompensated canceled shifts? Look, it happens to the absolute best of us, but don't panic because you still have moves to make. The key here is totally removing emotion from the equation. You need to keep a meticulous written paper trail to protect your tax home status and your stipend eligibility. Verbal promises, they evaporate into thin air. So if your promised hours aren't being delivered, document it via email immediately. Then review your exact exit options in the cancellation clause, and seriously, don't be afraid to escalate the issue to agency management if you need to. All right, section 4. S-corps and tax optimization. Let's talk numbers. On $350,000 of net income, simply electing to be an S-corp can save you roughly $9,900 in self-employment taxes compared to a standard sole proprietorship. I mean, think about that.
That is almost $10,000 extra dollars back in your pocket in a single year. Quite literally, just by checking a different box on your IRS forms. However, we have to be smart here because the IRS is definitely watching. They require you to pay yourself what they call a reasonable salary before you can take any of those tax-free distributions. So, taking a $50,000 salary on $400,000 of income, yeah, that is just begging to be put right in the IRS crosshairs. As a general locum pay guide rule of thumb, use defensible salary bands based on W-2 benchmarks. Look at MGMA or Doximity data to justify your salary, and please rigorously document your math to stay safe. That brings us to Section 5, Maximizing Retirement Contributions. Now, this next part is genuinely staggering. Because you act as both the employee and the employer, opening a solo 401k gives you nearly 3 times the contribution room as a standard employed physician. While a W-2 employed physician is currently capped at $24,500, you as a locum can shelter up to $72,000 in a single year. That directly equates to tens of thousands in immediate tax savings, which is just incredible. Honestly, it is genuinely surprising just how many locum physicians default to a SEP IRA simply because, well, it's a bit easier to set up. But because a SEP IRA completely lacks an employee deferral mechanism, high-earning locums are leaving massive tax shelters right on the table. For example, at $150,000 in income, the solo 401k lets you shelter almost double the amount compared to the SEP IRA. It's a no-brainer. And finally, Section 6, Negotiation Levers and Scripts.
Okay, I'm going to share a classic locum pay guide tactic with you right now. Try asking this. Is there a completion bonus available for this assignment? It's not in the offer I received. This single script takes exactly 30 seconds to say, costs you absolutely nothing, and it can uncover $500 to $2,000 that agencies simply won't offer proactively. The truth is they have it budgeted for high-demand assignments, but if you don't ask, they keep it. It's that simple.
Now, what about stipends? If you ask about the IRS per diem maximums for the city, you are instantly signaling that you know the rules of the game. But we really need to debunk a massive myth right here and now. The GSA per diem rate is just a maximum cap that the IRS allows. It is not a legal entitlement or some minimum the agency is forced to pay you. You still have to negotiate to get up to that GSA ceiling. Knowing this gives you room to negotiate for more tax-free money without even touching the overall bill rate.
But listen up, because knowing what is structurally impossible to change is honestly just as important as knowing what you can negotiate. You cannot negotiate MSA-locked margins, and you definitely can't negotiate a facility's hard bill rate ceiling. When you focus your energy on the levers that can actually move, rather than endlessly pushing on a locked door, it saves your leverage and preserves that all-important relationship with your recruiter.
So always demand the full itemized breakdown before you start negotiating, and absolutely never trust a blended headline number. Remember this strategic gem. Vague gets specific. Verbal gets written. Let me just say that again so it sticks. Vague gets specific. Verbal gets written. If a recruiter promises you something on a quick phone call, send an email immediately after saying, "Hey, just confirming what we discussed." Protect yourself with a solid paper trail every single time. It's time to audit your rates, use these negotiation scripts, and fully take back control of your career. But as we wrap up, I want to leave you with this one provocative question. If you don't know your exact tax home status right now, how much of your next locum paycheck is the IRS going to legally claim? Thanks so much for joining this edition of the Locum Pay Guide Explainer. We will see you in the next one.